Gold trading is a smart investment, especially during uncertain times. Understanding price trends helps traders make informed decisions. Here's a breakdown of key factors affecting gold prices and how to predict future movements. What drives gold prices? 1. Supply and demand. Gold prices fluctuate based on mining output and investor demand. Limited supply or increased demand, such as for jewelry or investments, raises prices. 2. Inflation and economic stability. Gold is a hedge against inflation. When inflation rises, gold prices increase as people seek safe investments. 3. Interest rates. Higher interest rates make bonds more attractive than gold, lowering its price. Lower rates boost gold demand and prices. 4. Geopolitical events. Wars, trade conflicts, and crises create uncertainty, increasing gold demand and pushing prices higher. 5. U.S. dollar strength. Gold and the U.S. dollar usually move in opposite directions. A weak dollar makes gold cheaper, increasing demand and raising prices. And 6. Central bank actions. When central banks buy gold, prices rise. Selling reserves increases supply, pushing prices down. Predicting gold price movements. 1. Fundamental analysis. Traders monitor inflation, GDP, employment rates, and central bank policies to anticipate price changes. 2. Technical analysis. Studying past price trends helps forecast future movements. Key tools include moving averages, help identify trends, RSI or Relative Strength Index, used to detect overbought or oversold conditions, candlestick patterns, analyzed to spot potential reversals. 3. Market sentiment. Analyzing investor sentiment through surveys and futures positioning helps gauge market direction. 4. News monitoring. Economic reports, central bank meetings, and global events influence gold prices. Next, let's move on to gold trading strategies. 1. Trend following. Traders follow long-term trends and invest accordingly. 2. Range trading. Buy at lower price levels and sell at higher resistance levels in a stable market. 3. News trading. Traders capitalize on price movements triggered by major news events. And 4. Scalping and day trading. Short-term traders profit from small, frequent trades using technical indicators. To conclude, gold trading is profitable when traders understand key market drivers. Using fundamental and technical analysis, monitoring trends, and adapting strategies leads to better decisions. Stay informed, track economic factors, and refine your approach to succeed in gold trading.